Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Linn Associates with your financial market update for this Monday, the 12th of February, 2018. These boards are going to erase soon, but I wanted you to see that the market had a nice rally, 400 points in the Dow, 114 in the NASDAQ, 36 in the S&P. It carried metals, dropped the dollar, and most currencies rallied against the dollar, and you were even higher than this in the last final minutes. As you can see, the boards are now erasing. That means we're at 4:45 p.m. Central Standard Time, but they won't change anything on our charts. So what we still have, if you go to the weekly chart, is downside bias. The market is still under the 18-week moving average of closes. Should the rally continue, I can make an argument then that you'll see resistance up at the 26.69 level. It's rare that you just slide through that number and don't come back and play around the 18-week moving average of closes. You don't have to, but as I told you before, you displayed weakness we haven't seen. Remember, you got under that number here. If you look at all of 2017, it did not happen. It did happen, and you can see that in November of 2016 and prior to that. 2017 was just plain an unusual year. I am of the opinion that we're going to see a more normal type of year going forward. Now, when I take a look at the daily bar chart, you can see the sizable correction as to how we came down from that peak all the way down here, bounced around. And when you put the swing line on, you get a better idea of what this market's done. You have the lower highs, you have the lower low, but this break right here didn't take out the one prior to it. So the market's starting to give you a bit of lower highs and higher lows. When we put on the 18-day moving average of closes, because the market's over the 100, should the market rally, and that's a big should, you might be able to get up to the 18-day average. But to do that, you'd have to take out 27, 26.75, which would change the chart picture from 2-1 of higher lows and a higher high under the 18-day average at that moment. I don't know if that'll happen because of that. What I can argue is that the market's fighting a battle at the 100-day moving average of closes, and the bias is down. What the market also did is on that big break, you got under the lower Bollinger Band a few times, but you've moved to the right-hand side of that. When we take a look at momentum, the momentum is sort of flat right here, out of, and this is important, out of oversold territory. So it did get oversold, and now it's out of it. Is the momentum pointing up? Really not yet. Could it? Yeah, but it's not doing it. So far, I'm going to label this a rally off an oversold condition where the market broke extremely hard, but it's not a change of anything just yet. When I go to the NASDAQ, I've got the same story. I've got clear-cut lower highs, lower lows. Yes, the market got under the 100-week average a couple of times last week. It managed on Friday to settle over it, and it's coming up. But just like the other indices, even if you had a big rally in the market, and don't get me wrong, 114 points is big, but I mean a big rally, and you got back over the 67.17 level, that's pretty big, right? You'd still be under the 18-week moving average, and more important, all you'd have out of the pattern is a lower low and a higher high. There's nothing I see on these charts. As a market technician, take the name off, forget their stock indices, take the values off. The chart pattern is not bullish. It's nothing, if anything, it's bearish, and it's getting a bounce in a bear market condition. When we go to the Dow, take your name off. Forget it's the Dow Jones. Lower highs, higher lows. A warning sign. No question about that. Not like the NASDAQ. It's back over the 100-day average. And again, this is a market that if it can get over 25.39, it could potentially set up a pattern of higher lows and higher highs. Then the question would be, could it close over the 18-day average? And if it did, Would you be a willing buyer with the stop back several hundred points under that? It's pretty hard. Actually, it's several thousand points. I said 100,000. 25,558 from 23,325. We're dealing in lots of big money. At simple numbers, it's $5 a point. It's a lot of money, folks. In the Russell, same story as we're seeing in all the others. Only the NASDAQ has the clearer bearish picture. You've got the lower highs but higher lows. You're back over the Bollinger Band. Momentum sort of flat. We're correcting, and the word is correcting, an oversold condition, but we haven't begun anything that shows an uptrend in the market. Now, when I go to the VIX, you've got a very clear pattern of higher lows but lower highs. Again, nothing going on there. The bias of the market is up because you're over the 18-day moving average of closes, but momentum is still pointing down. We're, again, still in that corrective zone. When we come to TLT, lower highs, lower lows. Still bearish with an embedded reading. There's nothing saying that interest rates on their own have done anything other than they're getting a bounce. Now in the March bonds, it's a little different. And that's because you had a big outside day up today, but you still have the embedded reading. Do I think that'll stop the bears from selling a hard rally? I do not. I think that the bears will still be looking at wherever the market reopens at that 18-day average of closes as a potential resistance point with lower highs, as long as the embedded reading, which is 15, does not get over 20 and stay over 20. That's the other part of the key. If it does, then it means you're going to that 18-day average, and maybe it's a reversal of momentum. Don't know. In the T-bond market, the 10-year note market, first thing my eye gets to is we're oversold. We're not embedded the way that we were with both numbers under 20 in the bonds. This is not, so it's oversold. Next thing I'm looking at, because of this huge rally right here that got over that, I'm going to call that a lower low, a higher high, a pullback that didn't take out the previous low, and then a rally off of that that slipped back a bit today. But the pattern, I could argue, is one of higher lows and a higher high. Even if I argue that, you can't get away from the fact that with today's action, you got a lower high. I think, again, a confusing chart picture. I'm seeing a lot of that right now on the financial markets. In the dollar index, the one thing I see is you're overbought. The second thing, higher lows, higher high. So that's friendly. Bias is up, but you're overbought. Let's assume you wanted to buy it here. Where would you put your stop? If you put it under the most recent lows at 88, let's call it 35, right in that zone. From where you're at, that's almost $2,000 risk. I'm not sure you're going to get a lot of interest in that. In the eurocurrency, I see a pattern of a higher high and a lower low, not a trend. The bias is down in an oversold market. Again, a difficult market. In the British pound, you made a run on Friday for the lower Bollinger Band. You got to 137.80, right in that zone of the lower Bollinger Band. And today you got a small, if you will, inside day, a bounce, if you will. But you're oversold in a downtrend with lower highs, lower lows. Again, do you want to sell an oversold condition? In the Japanese yen, you are overbought. So the first thing you ask yourself, and this is what I teach in my charting course, would you want to buy an overbought condition? Got my doubts. Higher lows, higher highs. So still in an uptrend, but overbought. Supports back at 91.55, a good 70 points lower. That's hard market. Now on Bitcoin, there's enough days for me to finally say, okay, what we can look at maybe is what is the market doing. Now, I thought I had this well over there, and then I moved it over here. So I have a higher high, and then I've got a market that's getting a bounce. So I got a higher high and a lower low. I don't have a trend. I have a market that's trying to work up to a resistance point, which might be as high as 97.65. The trend turns down, though. If the market makes right here and gets under today's low, for example, That was 8,075. So you'd have lower highs and lower lows at that point. So the first time we take out a previous day's low as this market's edging up the way it is, the market reverts back into its downtrend as long as prices stay under the 18-day average at 97.65. It is still exceptionally volatile. You do realize that just days ago this market was sitting at 59.70. It's now up $3,000 from there. And yes, we're getting calls from people. They're asking if you want to trade it yet. I know a lot of us firms are still hesitant because of this risk. The volatility is just too big. The CBOE margin for a mini contract is 44% of the previous day's settlement. So they went away from a number. I went on their website just now to see how they're doing it, and I know a lot of the clearing firms are still saying, why don't we give the market 6 months and let's see how it gets under its belt. I still think the size of Bitcoin contracts are too big. I think they should be 1/10 the size of one Bitcoin from the CBOE, and the Merck should be a full-size contract, but they won't compete with the CBOE, so I don't know where the two exchanges go. But I am not seeing retail and or institutional interest yet in those markets to build the open interest the way that I thought they would build. In the April Brent versus the April WTI crude, we're back down into that 350 zone. You're still seeing this market being coming down, if you will, as the market's trying to get these two contract prices closer together. Now, I've got March up here, but I know this is the April contract. Sorry about that. My protege or my assistant didn't do it right. Guess who the assistant and protege is? I missed it. So this market got down to the 100-day average, bounced back over the lower Bollinger Band. It is oversold. It's in a well-entrenched downtrend. Hard rallies probably are still what the pros are looking for to sell into that resistance zone. This is the March WTI crude. So the April Brent is what this should be, and that is just my error. This is the March, and you can see lower highs, lower lows, still under the lower Bollinger Band. Now, that is today. Friday we were under it. If we go to this day, we were under it on Thursday, and we were under that day on Wednesday. So we have 4 days in a row of being under the lower Bollinger Band. You generally end at the 5th day. That doesn't mean it can't go beyond that. But the percentages now for tomorrow are about 1% that the market won't try to get over that number. Obviously, the market's going to be looking at the API numbers that come out in the afternoon to get a feel for what's going on. In the gasoline, look at how this market has just plunged underneath all those numbers. We are hearing that Russia has agreed to stay with OPEC and end the production cuts, but it would like to see it, according to their statements, in a 5-month period. So let's assume that they get to June and this thing starts winding itself down. More supply on the market, the U.S. producing more supply. If prices stay strong for WTI near $60, we've seen that that brings out the producers. Certainly anything near 65, 66. We brought on 26 more rigs Friday, so that gives you an idea as to what it's done. As for gasoline, coming down, but you've got to keep in the back of your mind that spring maintenance isn't far away, and all of a sudden the draws will happen in stockpiles. That doesn't mean the trend has changed. This market's bearish, oversold, getting a bit extended. Nat gas, the weather forecasts are coming out much milder than at first thought for the next 2-week period. So you can see how this market has gone into what we call a vertical decline. Up here from the 325 area, wow, 75 cents. Literally like that with an embedded reading. It's a hard market to get short, but short is the trend of the market at this point in time. I want to remind you about our price counts, and I happen to do now the financial price counts for the CIS group that puts these out, and that's Commodity Information Systems. And to make a long story short, the nice thing about it is they put together price counts on energies, the grains, the meat markets, the financial markets. So if you'd like to get a free sample, all you need to do is go to our website, sign up for the price counts. We'll make sure that we get you into that. You also get a chart of the day. This is turning into a paid subscription service. So my advice to you, if you haven't had a free trial, you might want to try a week or two of that, get a feel for what we're doing, and it gives you an idea of where we think markets might go after trends have set in. I'm Ira Epstein. You have yourself a good day, and I will talk to you all tomorrow.